Hi, I'm Leanna Haakons. Welcome to the SALT Sideline Report. We are here back in real life in New York City with Glenn Barber. He is the head of business development and sales at Copper. Welcome.
Hey, nice to see you. Thanks so much for having me.
Well, we're happy to have you back here, SALT in real life, seeing real people again. We're loving the energy here, and we're so glad that you joined us for a panel today on the institutional adoption of crypto, which is a really big topic at SALT this week. We have lots of experts in the field, including yourself from Copper. You guys deal with institutional investors only.
Yes. In
the digital asset space. Tell us some of your takeaways from the panel today, and then I want to ask you a little bit more about Copper directly as well.
Sure. Look, I think the panel went really well. We really appreciate being here at SALT. You guys do a lot to espouse the institutionalization of a lot of asset classes. And, as a new asset class, I think one of our responsibilities at SALT and in other places is to get institutional investors much more comfortable with crypto, right? And there's been a huge influx of demand, but I think that people are very wary and not yet well informed about what this asset class represents, whether it's a true investment opportunity. And it's our job to make sure that they get comfortable, because we do believe it's a legitimate asset class. And I'll say two major things that we hope resonate, right? One is that the underlying blockchain technology is going to be the core underpinning of the new global economy as we go forward in the next 5 to 10 years. And the digital currencies that sit on top of that blockchain are the capital markets opportunity of that next generation.
And so I know that being with Copper, you guys really focus on the settlement and custody side of digital assets. What are some challenges in that space when it comes to institutional adoption? And how is Copper solving some of those roadblocks that people have been a little bit confused about in this new asset class over the last few years that this has been developing?
Sure. I mean, I think as more and more institutions get into the business, right, we see more and more fiduciary responsibility. So people managing other people's money. And the worst thing that can possibly happen to these people is that they lose it or it's stolen, right? So what Copper tries to do is to create a fail-safe that says there is extremely little risk, or if not no risk, of your account being hacked and that your customer assets are going to disappear, right? On top of that, other institutions really believe that counterparty risk is something that can be mitigated. And we have a solution called ClearLoop that allows people to trade from their cold wallets, which are not connected to the internet and not susceptible to hacking, right? For all intents and purposes, and to trade out of those without putting their assets at risk. And so between the custody solution that we offer, which generally eliminates what we call a single point of failure, which prevents most hacking and theft from happening, and this elimination of counterparty risk through our ClearLoop solution, we believe that we're trying to address two of the major points that institutional investors need to get comfortable with in order to put more money to work in this fast-growing asset class.
And who are some of the early adopters in the institutional space of digital assets? What were some of the first clients that Copper started to see, and how do you see that changing down the road?
Sure. I mean, I think I would loosely bucket into three segments, right? First, you have the digitally native hedge funds, payment processors, and basically anyone that started in crypto and was always familiar with the technology and the underlying blockchain, right? Then you had pockets of money that were coming from institutions that were generally responsible for themselves. A family office is a perfect example. They believe in the value proposition of Bitcoin, for example, and they want to put some money to work. They really only have themselves to answer to in terms of that investment decision and risk, and therefore they make their own decisions. And now the third bucket are all the other people that I mentioned earlier, your traditional asset managers, your wealth managers, RIAs, and people that have a fiduciary responsibility to safekeep and care for their clients' assets. And so these are the people that really want to see the continued building out of the infrastructure, the pipes and plumbing, and really the investor protections that we take for granted because they've been layered into our traditional financial system over the past couple of decades.
And that does take time to establish that trust and those processes for a new asset class, particularly a digital asset class, which I think I've said more times on the Sideline Report this week than I've ever said in my life. I'm going to ask you a tough question now to finish this off. Maybe you can or can't answer it, but you probably get asked it all the time. What do you see the timeline or your forecast of mainstream institutional adoption of crypto and digital assets? What do you think that looks like?
That's a great question, and I don't think there's any right answer. But to put some perspective on it, and this is something that I mentioned in the panel discussion today, right, is that I truly believe in 10 to 15 years, with the way that blockchain technology and peer-to-peer permissionless decentralized databases accelerate, they will bring tremendous technological efficiency and scale to almost every single industry. You can talk about transportation, logistics, finance, agriculture, and the like, right? And so in 10 to 15 years, you're going to see these, what we call DAOs, or decentralized autonomous organizations, that will be sitting alongside your Facebooks, your Teslas, your Apples, and doing business in a way, right? Along the same thing as we call a company. And so the digital currencies associated with these blockchains are nothing more than an incentive mechanism to help them go and reduce friction. And so these are going to be the asset classes. So I think that from the investment perspective, I think in the next 2 to 3 years, people will get much more comfortable with the idea that a digital currency, the way we're talking about it, is more just a valuation, a representation of value from the underlying blockchain. And in a poor analogy is sort of the equity of the blockchain corporation, right? The value transfer is very different. It's not perfectly analogous, but in order to get people that are new to digital assets to really kind of comprehend it, the digital currency is the manifestation of the value, and the blockchain is sort of the corporate entity that is generating that value. And I think in 2 to 3 years, people will pay a lot more attention and understand that well enough to then say over the next 5 to 10 years, our economy, our global economy, because this is global, permissionless, and borderless, is going to look very different from what we know it today.
And with some of those protections and safeguards that Copper is providing for institutional investors, that can give people a little bit of comfort in maybe diving into the space a bit more.
Yeah, absolutely. I mean, one of the ways we would love to work with Salt, for example, right, is to expand their investment offerings to their client base, right? Because I think that at least now, and understandably so, most investment opportunities in the digital asset space are limited to trusts and investments in Bitcoin, perhaps Ether as the second biggest digital currency. But like the internet age, right, and like the internet boom, there are literally thousands of these investment opportunities, and not all of them are good ones. But I think that if you look at the development of crypto infrastructure, there are a lot of blockchains and associated digital currencies that investors should be aware of that have the upside potential that is more, significantly more than Bitcoin, for example. And so I think that as the investment opportunities become a little bit more sophisticated and broadened, the returns can also be a little more outsized than they would be with just Bitcoin.
Well, we're lucky to have an expert like you in the space to be here with us today to break it down on the Sideline Report. Thank you for joining us, Glenn, and thank you for being a part of SALT this year.
Thanks so much for having me.